Compound interest is often called the eighth wonder of the world, and for good reason. It's a powerful force that can turn small, consistent investments into substantial wealth over time. The beauty of compound interest lies in its ability to generate returns not just on your initial investment, but also on the accumulated interest from previous periods. Let's break it down in simple terms. When you invest money, you earn interest on that principal amount. With compound interest, you then start earning interest on that interest as well. It's like a snowball rolling down a hill, gathering more snow and growing larger with each rotation. For example, imagine you invest $1,000 at a 5% annual interest rate. After the first year, you'd have $1,050. But in the second year, you'd earn 5% on $50, not just the original $1,000. This process continues year after year, accelerating your wealth growth. The power of compound interest becomes truly evident over long periods. Let's say you start investing $200 per month at age 25, earning an average annual return of 7%. By the time you reach 65, you'd have invested a total of $96,000 out of pocket. But thanks to compound interest, your investment would have grown to over $600,000. One of the key factors in harnessing the power of compound interest is time. The earlier you start investing, the more time your money has to grow. This is why financial advisors often stress the importance of starting to save and invest as early as possible. Consider two individuals, Alex, who starts investing $300 monthly at age 25, and Sam, who waits until 35 to start investing $450 monthly. Both invest until age 65. Assuming a 7% annual return, Alex would end up with about $1 million, while Sam would have around $740,000. Despite investing $18,000 more overall, Sam ends up with significantly less due to the lost decade of compound growth. Another crucial aspect of compound interest is the frequency of compounding. The more frequently interest is calculated and added to your principal, the faster your money grows. Daily compounding will result in more growth than monthly or yearly compounding, all other factors being equal. It's not just about saving accounts, though. The concept of compound returns applies to various investments, including stocks, bonds, and mutual funds. When you reinvest dividends from stocks or interest payments from bonds, you're essentially compounding your returns. Compound interest isn't just a boon for long-term investors, it's also a powerful tool for achieving shorter-term financial goals. Say you're saving for a down payment on a house in 5 years. By leveraging compound interest through high-yield savings accounts or short-term investments, you can reach your goal faster than by simply setting aside a fixed amount each month. However, it's important to note that compound interest is a double-edged sword. While it can work wonders for your savings and investments, it can also work against you when it comes to debt, particularly high-interest debt, like credit cards. When you carry a balance on your credit card, interest compounds on your unpaid balance, potentially leading to a debt spiral if not managed properly. This is why financial experts often advise paying off high-interest debt before focusing on investing. The interest you save by paying off a credit card with a 20% APR is essentially a guaranteed 20% return on your money, a rate of return that's hard to beat in the investment world. The power of compound interest also underscores the importance of patience in investing. It's easy to get discouraged when you don't see immediate, dramatic results from your investments, but compound interest is like planting a tree. It takes time to see significant growth, but once it starts, the growth can be exponential. Consider the Rule of 72 as a quick way to understand the impact of compound interest. This rule states that you can estimate how long it will take for your money to double by dividing 72 by your annual return rate. For instance, at a 7% annual return, your money would double roughly every 10 years. 72 with 7 equals 10.3. While the concept of compound interest is straightforward, its implications for personal finance are profound. It emphasizes the value of consistent, long-term investing over trying to time the market or make quick gains. Even small, regular contributions to your investment accounts can lead to significant wealth accumulation over time. For young adults just starting their careers, understanding compound interest can be a game changer. It provides a compelling reason to start saving and investing early, even if the amounts seem small. A 22-year-old who invests just $50 a week could potentially have over $1 million by retirement age, assuming historical average market returns. Compound interest also highlights the importance of choosing the right investments. While a high-yield savings account might offer 2% interest, the stock market has historically provided average annual returns of around 7% after inflation. Over decades, this difference in return rates can result in hundreds of thousands of dollars in additional wealth. However, it's crucial to balance the potential for higher returns with your risk tolerance and investment timeline. Younger investors can generally afford to take on more risk, potentially earning higher returns, while those closer to retirement might prefer more stable, lower-yield investments. The concept of compound interest extends beyond just financial investments. It applies to personal and professional growth as well. Small, consistent efforts in learning new skills, networking, or improving your health can compound over time, leading to significant life improvements. In the realm of personal finance, compound interest teaches us several valuable lessons. It encourages discipline and consistency in saving and investing. It demonstrates the value of starting early and being patient, and it shows us that even small actions, when repeated over time, can lead to remarkable results. As you navigate your financial journey, keep the power of compound interest in mind. Whether you're just starting to save, planning for retirement, or working towards other financial goals, understanding and harnessing compound interest can be your secret weapon for building long-term wealth. Remember, the best time to start investing was yesterday. The second best time is today. So, why not take a small step towards your financial future right now? Even a modest beginning, when combined with the magic of compound interest, can grow into something truly remarkable over time. Your future self will thank you for the power of the decisions you make today.